They call it Dr. Copper for a reason, because when copper moves, the global economy is already talking. And right now, copper just did something it has not done in years. Prices are pushing toward record highs, not because of speculation, but because the world is quietly running out of it. Data centers, AI infrastructure, the energy grid, they all need one thing in common. And the countries that control the supply know exactly what that means. Welcome back to Currency Arc Insight. If you are new here, this channel breaks down the real signals behind gold, silver, and the metals markets that quietly shape the global economy. Without the noise, without the hype, just the analysis that serious investors need to see coming. Today we are turning to a metal that rarely gets the spotlight, but may be sending the loudest warning of all: copper. Copper is trading near $6.47 per pound, a level not seen in years, and the number tells only part of the story. Over the past 12 months, the price of copper has climbed more than 45%, an increase that has quietly outpaced most conversations happening in mainstream financial media. While attention remains fixed on gold and silver, copper has been building toward a supply crisis that is now impossible to ignore. To understand why this matters, it helps to remember why copper carries the nickname Dr. Copper among analysts. Unlike gold, which often moves on fear and monetary policy, copper is a purely industrial metal. It runs through nearly every part of the modern economy, from construction wiring to power grids to the machinery that keeps factories running. When copper prices rise sharply, it is rarely because of speculation alone. It usually means something structural is happening beneath the surface of global supply and demand. That is exactly what is unfolding right now. The first pressure point is China, the world's largest consumer of copper and the country most responsible for turning raw copper into usable industrial material. China is currently facing a shortage of both copper concentrate, the raw ore extracted from mines, and copper scrap, the recycled material that smelters rely on to supplement primary supply. When both of these inputs become scarce at the same time, smelters are forced to compete harder for available material. This has pushed treatment charges higher, the fees smelters earn for processing raw copper into refined metal. Rising treatment charges are a signal that the entire refining pipeline in China is under strain, and that strain is now spilling into global pricing. The second major factor is the United States, though not for the reason many investors initially assume. Tariff threats on semi-finished and unwrought copper products have created a powerful incentive for traders to move copper into the United States, ahead of any formal implementation. This is not a story of America suddenly needing more copper for its own economy. It is a story of copper being relocated for strategic positioning, as traders and importers attempt to get ahead of potential tariff costs before they take effect. The result is a large-scale shift of physical copper away from the rest of the world and into American storage. This shift becomes even clearer when looking at COMEX inventories, the copper stockpiles held in United States exchange warehouses. Just 1 year ago, COMEX copper inventories stood at less than 100,000 metric tons. Today, that figure has surged past 500,000 metric tons, a five-fold increase in a single year. This is not a gradual accumulation driven by ordinary demand growth. It is a rapid, deliberate stockpiling event, and it reflects how seriously global traders are treating the risk of new American trade barriers on copper. When these three forces are combined, a clear picture begins to form. China is struggling to source enough raw material to keep its refining system running smoothly. The United States is pulling in copper at an accelerated pace, driven by tariff positioning rather than organic industrial need. And the global supply of copper available outside the United States is shrinking as a direct result. This is the essence of the copper squeeze. It is not simply a matter of copper becoming more expensive. It is a matter of physical copper being pulled out of global circulation and concentrated in one country, while the rest of the world is left competing for a smaller and smaller pool of available metal. For an economy that depends on copper for everything from electrical infrastructure to industrial manufacturing, this kind of concentration carries consequences that extend far beyond a single commodity chart. What makes this moment particularly important is timing. This supply tightening is happening at the same time that new sources of demand are emerging, sources tied to artificial intelligence infrastructure and global energy expansion. Before those demand pressures are addressed, it is essential to understand that the foundation of today's copper market is already unstable. The squeeze did not begin with AI or data centers. It began with a supply chain quietly buckling under the weight of geopolitical strategy. And that is the warning Dr. Copper is sending right now. The copper squeeze building in global supply would be concerning enough on its own, but it is colliding with a second force that few investors have fully priced in: the artificial intelligence build-out. Data centers, the physical facilities that power AI systems, are consuming copper at a pace and in a manner the market has rarely seen before. This is not ordinary industrial demand that rises and falls with economic cycles. Analysts describe it as inelastic demand, meaning developers purchase the copper they need regardless of price. When a company is racing to bring a new data center online, the cost of copper becomes almost irrelevant compared to the cost of delay. That single dynamic changes how copper behaves as a commodity. This is where copper diverges sharply from how industrial metals traditionally trade. In past cycles, rising prices would eventually discourage demand as buyers slowed purchases or sought substitutes. AI infrastructure does not follow that pattern. Data centers require copper for wiring, cooling systems, and power distribution, and none of those components can be delayed simply because prices have climbed. The metal is being bought first, with cost considerations coming second. Layered on top of this is a broader shift in how power infrastructure itself is being funded. According to Goldman Sachs research, grid and power infrastructure investment is increasingly tied not just to AI expansion, but also to defense spending, as governments and private companies alike prioritize energy security and computing capacity as strategic assets. This means copper demand is no longer driven purely by economic growth. It is being driven by national and corporate priorities that treat infrastructure build-out as a matter of long-term positioning rather than short-term cost management. When defense and AI priorities are pushing investment in the same direction, price sensitivity becomes almost secondary to the buyers involved. The clearest evidence that something unusual is happening in copper comes from comparing it to steel. Both are essential industrial metals, and both have faced similar tariff pressures and trade policy uncertainty over the past year. Yet steel has not experienced anything close to the speculative intensity seen in copper. Steel markets absorb tariff announcements in a relatively orderly way, without triggering the kind of aggressive stockpiling or investor frenzy now visible in copper trading. This contrast matters because it shows that copper's current price behavior cannot be explained by trade policy alone. If tariffs were the only driver, steel would likely be reacting in a similar way. The fact that it is not suggests copper is being pulled by a demand story unique to itself, one connected directly to the AI infrastructure race. Taken together, this points to a deeper shift in how copper should be understood as an asset. For most of its history, copper demand has moved with the broader industrial cycle, rising during periods of construction and manufacturing growth, and falling during slowdowns. That relationship is changing. Copper demand is becoming structurally linked to the AI arms race, a race that shows no sign of slowing, regardless of where the broader economy stands. Data centers are not being built because of a temporary boom. They are being built because governments and corporations view AI capacity as a long-term strategic necessity, similar to how energy security or defense capability is treated. This creates a new kind of pressure on an already tightening supply chain. The squeeze described earlier, driven by Chinese shortages and American tariff positioning, was already reducing the amount of copper available in global markets. Now that shrinking supply is being met by a category of demand that does not respond to price the way traditional industrial buyers do. When inelastic demand meets constrained supply, the normal rules of commodity pricing begin to break down. This is the piece of the copper story that separates it from previous industrial metal cycles. It is no longer simply a matter of economic growth pulling copper prices higher. It is a structural collision between a tightening physical supply chain and a category of demand tied directly to the infrastructure race defining this decade. Understanding that distinction is essential to understanding why copper's warning signal may be different and potentially more serious than anything seen in past commodity cycles. While demand for copper is accelerating in ways the market has never fully experienced, the supply side of the equation is proving to be far more fragile than most investors realize. Understanding this fragility is essential because it reveals that the copper squeeze is not simply a temporary imbalance. It is the result of structural weaknesses in global production that will take years, not months, to resolve. The clearest example comes from Chile, the world's largest copper-producing nation. In August of 2025, a major collapse occurred at one of Codelco's key mining operations following an earthquake at the site. The disaster killed 6 workers and forced a significant portion of the mine offline. According to company executives, production at the site is now expected to reach roughly 301,000 metric tons in 2026, but the operation is not projected to return to full capacity for another 5 years. This is not a short-term disruption that the market can simply wait out. It represents a multi-year reduction in output from one of the most important copper sources on the planet, and it removes a meaningful buffer of supply that the global market had previously relied on. Compounding this problem is a separate and less visible crisis unfolding in the chemical supply chains that copper production depends on. Sulfuric acid plays a critical role in extracting copper through processes used extensively in Chile and the Democratic Republic of Congo. Following renewed tensions surrounding the Strait of Hormuz, a vital shipping route for chemical and energy products, sulfuric acid prices have surged to record levels in key regions. When the cost of a core input required for copper extraction spikes this dramatically, it directly threatens the economics of production, even at mines that are otherwise operating normally. This means the disruption is not limited to Chile's earthquake-damaged mine. It extends across the extraction process in multiple major copper-producing regions, adding a second layer of fragility to global supply. Against this backdrop, new mining projects in Chile, the Democratic Republic of Congo, Brazil, and Iran are expected to help lift global copper output by roughly 2.3% in 2026. On the surface, this sounds like meaningful growth. However, analysts remain deeply divided over whether this increase is sufficient to offset the combined pressures already straining the market. Some point out that new mine development takes years to reach full production, meaning near-term relief will be limited even as these projects come online. Others note that geopolitical instability in several of these regions introduces its own risks, meaning projected output increases are far from guaranteed. This is the core issue investors need to understand. Copper supply is not simply tight because of temporary disruptions. It is structurally fragile, and that fragility is concentrated in regions exposed to earthquakes, geopolitical conflict, and chemical supply chain instability, all at the exact moment global demand is accelerating due to the AI infrastructure build-out described earlier. A mining collapse in Chile takes years to fully repair. A shipping route disruption near the Strait of Hormuz can spike input costs almost overnight. And new production growth, while helpful, is neither fast enough nor certain enough to be treated as a guaranteed solution. When supply is this exposed to geopolitical risk, even small disruptions can have outsized effects on global pricing. The market is no longer operating with the kind of supply buffer that historically allowed it to absorb shocks without major price movement. Instead, every new disruption, whether a natural disaster, a shipping route conflict, or a delay in mine development, lands directly on a market that is already stretched thin. This is why the supply side of the copper story cannot be viewed as a temporary bottleneck waiting to resolve itself. It is a fragile, geopolitically exposed foundation, and it is holding up a demand story that shows no signs of slowing down. As the following section will show, this collision between fragile supply and accelerating demand is creating a divide on Wall Street, one where even the most sophisticated analysts cannot agree on where copper goes from here. With supply constrained and demand accelerating in ways the market has never quite seen before, one might expect Wall Street to be unified in its outlook for copper. Instead, the opposite is true. The forecasts coming from the world's largest financial institutions are scattered across a wide range, and that divergence itself is worth paying close attention to. Goldman Sachs projects copper prices to settle somewhere between $10,000 and $11,000 per ton, framing this as a modest pullback from recent highs before demand from grid and power infrastructure pushes prices upward again over the longer terms. Macquarie, by contrast, has taken a far more bullish stance, raising its forecast to as high as $13,165 per ton. Bernstein sits in between, projecting an average closer to $12,419 per ton. Meanwhile, Bank of America has issued a notably more conservative outlook, forecasting an average price equivalent to roughly $5.13 per pound, a figure well below where copper is currently trading. This is not a minor disagreement over decimal points. These institutions, all staffed with experienced commodity analysts using access to the same underlying data, have arrived at meaningfully different conclusions about where copper is headed. That alone should signal to investors that this market is anything but settled. Part of the reason for this divergence lies in China, the world's largest consumer of copper. Recent data shows Chinese manufacturing activity slowing to its weakest pace in 4 months, with both output and new orders expanding more slowly than expected. At the same time, China's leadership has signaled it will continue relying on existing economic policy tools, rather than introducing the kind of broad-based stimulus that markets often anticipate during periods of slowing growth. This matters because refined copper demand in China has already declined sharply, and without significant stimulus, there is little on the horizon to reverse that trend in the near term. This creates a genuine tension at the heart of the copper story. On one side is the long-term structural case driven by AI infrastructure, grid expansion, and the supply fragility discussed earlier. On the other side is a more immediate concern, a slowing Chinese economy that is pulling back on refined copper demand right now, not years from now. Macquarie has gone as far as forecasting substantial supply surpluses for 2027 and 2028, suggesting that today's tightness could eventually give way to oversupply once new mining projects mature and Chinese demand fails to keep pace. This is the tension investors need to sit with. The bullish case for copper rests on structural forces that unfold over years: AI infrastructure build-out, grid modernization, and constrained mine supply. The bearish case rests on something far more immediate: a major economy slowing down in real time, with policymakers showing little urgency to intervene. Both of these forces are real, and both are currently active in the market at the same time. What this divergence ultimately reveals is not confusion for its own sake, but instability. When the most sophisticated financial institutions in the world, each with access to extensive data and research resources, cannot agree on where copper is headed, it suggests the underlying setup is genuinely unstable rather than simply difficult to interpret. Markets tend to price in consensus when the picture is clear. Right now, no such consensus exists for copper, and that absence of agreement is itself a signal worth taking seriously. As the final section will explore, this uncertainty does not mean investors should ignore copper. It means copper's warning should be understood in its proper context, as one part of a broader picture that includes gold, silver, and the economic pressures already reshaping global markets. Everything examined so far, the tightening supply chain, the AI-driven demand shock, the fragile mining infrastructure, and the sharp disagreement among Wall Street's top forecasters, points to a single conclusion that fits squarely within what this channel has been tracking for months. Metals are not moving in isolation. They are signaling deeper stress building beneath the surface of the global economy. And copper is simply the latest and perhaps clearest voice in that signal. For years, gold and silver have served as the primary indicators, followed by investors seeking to understand where the broader economy is heading, particularly during periods of monetary uncertainty and shifting central bank policy. Copper tells a different but equally important part of that story. While gold and silver often reflect fear, currency debasement, and safe haven positioning, copper reflects something more immediate, the real physical demands of industrial activity, energy infrastructure, and now, the AI-driven build-out reshaping the global economy. This is why copper has long been referred to as a leading indicator for industrial demand, functioning much like a canary in the coal mine. When copper behaves erratically, as it is doing now, it often means broader economic conditions are shifting before those shifts become visible anywhere else. What makes the current moment particularly significant is how copper and precious metals are now telling a related story from two different angles. Gold and silver continue to act as the counterweight, the assets investors turn to when confidence in monetary stability weakens. Copper, meanwhile, is exposing the fragility building within the physical, industrial side of the economy. Supply chains stretched thin, mining output constrained by geopolitical risk, and demand increasingly driven by strategic priorities rather than ordinary economic growth. When both of these signals are flashing at the same time, it becomes harder to dismiss either one as a passing fluctuation. For investors watching this space, there are a few developments worth tracking closely in the months ahead. The first is any formal decision on United States tariffs affecting unwrought and semi-finished copper, since this will directly influence how much physical metal continues flowing into American warehouses versus the rest of the world. The second is China, specifically whether Beijing shifts away from its current approach and introduces more direct stimulus measures. Any change here could meaningfully alter both refined copper demand and the broader industrial growth outlook. The third is mine supply, particularly updates on Codelco's recovery timeline in Chile, and whether new projects in the Democratic Republic of Congo, Brazil, and Iran progress on schedule or face further delays. Each of these developments has the potential to shift the balance between the bullish, structurally driven case for copper and the more cautious, near-term risks tied to a slowing Chinese economy. Investors who stay ahead of these signals will be far better positioned to understand not just where copper is headed, but what it reveals about the broader economic environment taking shape. This is precisely the kind of analysis Currency Arc Insight is built around, looking beyond the headlines to understand what the metals markets are actually signaling about the economy's underlying condition. If you found this breakdown valuable, consider subscribing so you do not miss the next warning sign as it emerges, and share your thoughts in the comments on where you believe copper is headed next. Thank you for watching, and we will see you in the next video.